Good morning, everyone, and welcome to Prestige Wealth Management Group's exclusive economic webinar with Dr. Jeremy Siegel. I think we are all eager to hear Dr. Siegel's remarks today, but before we do so, just a couple of housekeeping items. As a reminder, today's webcast will be recorded, so if you guys registered, you will receive a recording of that. And we will not be able to take any live questions today, but if you do have any questions for us, please send those in to pwm@prestigewmg.com, and we'll be sure to get back to you. Although Dr. Siegel probably does not need any introduction, I will provide one anyway. Dr. Jeremy Siegel is the Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania and Wisdom Tree Senior Economist. Professor Siegel has written and lectured extensively about the economy and financial markets and is a regular contributor to the financial news media. In 1994, he received the highest teaching rating in ranking of business school professors conducted by Businessweek. And last but not least, his book, Stock for the Long Run, now in the 6th edition, was named by the Washington Post as one of the 10 best investment books of all time. His second book, The Future for Investors, is also a bestseller. With that, I'm going to turn it over to Dr. Jeremy Siegel to get started for some remarks.
Well, thank you very much, Michael. Happy to be with you in these turbulent times. I think it's important to start out. I'm going to put all my chips on the table about where I stand on this, and then I'm going to tell you what it affects the stock market, the bond market, and your investments going forward. But listen, I like a lot of things Trump does. And cost saving, deregulation, tax cuts. But any of you who have followed me, and I know many of you have, I am absolutely not a fan of these tariffs at all. I think I do think it's important for me to give the reasons why very shortly, and that does shape how I look at what might happen further. First of all, the loss of 20 million manufacturing jobs over the last 40 or 50 years is not due to unfair tariff practices, is not due to trade restrictions by foreign countries on us. The simple matter, and economists have studied it, is that 90 to 95% of the manufacturing loss just has to do with the fact that there is cheaper labor abroad. What that means is even if they had no restrictions whatsoever on any U.S. exports at all, we would still have a huge trade deficit. The trade deficit, and I've written on this on the Wall Street Journal. It's published as a major op-ed piece. Trade deficit is mostly the result of foreigners taking the dollars and wanting to, instead of buying our goods, wanting to buy our investments because we are the best place to buy investments in the world. And trade would not be balanced if there were no restrictions, would not at all. And in fact, the only way a country can become a reserve currency is to run a trade deficit, because dollars have to flow abroad for them to use in transactions and as part of their liquid assets. And it's impossible to do that unless you have a trade deficit. Trade deficit is not an emergency. It is not a reason why, the manufacturing jobs left. The manufacturing jobs left because plants could be built with labor that was as skilled as our labor at 20% of the cost that we had now. Okay, so I've been teaching this for years, and the evidence is absolutely overwhelming on that particular case. So what does that mean? Ultimately, these jobs won't be brought back. A tiny percent will be brought back. But that, of course, does not mean that Donald Trump cannot declare victory. First of all, I do want trade restrictions to be brought down. I think that does help us net if they are brought down. But I think the cost of tariffs, at least as they stand right now, are far, far higher than the cost of any benefits that might be negotiated on the other side. Okay, so what does that mean? And as long as these tariffs are in effect, I see it hard time to make a lot of progress on the stock market, very honestly. I don't see, I mean, necessarily that there's going to be a recession. There might be. The average decline in a recession in the stock market is about 24%. We're about 15, 16 now. So, maybe you could say we're near 10%. It depends on certainly a lot of things, and no one should, of course, ever wait for the bottom. I don't wait for the bottom. No one knows where the bottom is. The question is, are there great holdings, right now that you can hold? Let me comment a little bit on the current situation, and on how it might develop. I regard really these first quarter earnings as not being really interesting because it's a question of what's going to happen under tariffs, and none of the first quarter earnings have that. I actually don't even regard. I mean, some of the CEOs are making projections. We had United Airlines CEO Kirby say, "Well, this is our projection if we have a recession. This is a projection if we don't." And there was a huge gap between the two. The truth of the matter is, in my opinion, on these conference calls, either this quarter or absolutely very soon, I think every CEO should sit down with his or her management team and say, "All right, if we got these tariffs, what is the real effect going to be? Let's do our best guess." Um, now, let me say, that even Trump has, as you know, paused the reciprocal tariffs. Um, but the 10% tariff looks like a baseline for a while. I don't know. And that's not insignificant. And probably 20% on China. Well, right now it's 140% on China. So, I mean, that, and they're talking about what the conditions of the talks are. We had some Chinese news this morning about what the conditions they would talk. Trump has not directly responded to China at this particular juncture. He's working on a deal with Japan. He has other deals. He will be announcing deals. My best opinion, my recommendation for Trump would be negotiate as many deals as you can, and then make an off ramp, declare victory, and begin to take off these tariffs. One thing you do definitely see, I mean, even with the tariffs paused on computers and computer chips, I mean, you take a look. We here at Wisdom Tree, I know at LPL, diversification is important. You could have rode the NVIDIA tech boom for a long time, but it broke. I pointed out 6 weeks ago, it finally broke the trend line, which means we get a change in narrative. The narrative is beginning to change on AI. It actually began way before the tariffs. Narrative began to change on AI with DeepSeek. And then with BYD, the Japanese electric vehicle manufacturer, beginning to develop self-drive, et cetera, and so on, and on other developments, which put into question whether these stocks can go up forever. And no stock goes up forever. I mean, I'm old enough to have followed the market to realize that, and that is what is so important for diversification. Finally, we begin to see these value stocks begin to assert themselves, and dividend-paying stocks also are important. Dividend-paying stocks are, a lot of people take a look at these dividend-paying stocks, say, "Oh, look, at 3 or 4%, I can get 4% on treasuries." Remember, treasuries do not provide you with inflation protection. You can only buy Treasury inflation-protected bonds, and they're now going for, I mean, if I take a look at my screen right now, 2.1%. That's it. And it's totally taxable. In fact, it's a terrible tax situation with the Treasury tips. But 2% after inflation. I mean, stocks are absolutely inflation protector. And over medium and long terms. They are absolutely inflation protectors. And that's the direction to go. As far as bonds are concerned, I do realize that treasuries do offer a certain return. There's some comfort. You can, still you can get 4.2, 4.3 on the nominal 10-year. But if you're worried about inflation, there's no inflation protection on those bonds. And again, if you want the inflation protection, you get less than half that amount. So there's to me, stocks are absolutely the asset of choice. Now, again, if these tariffs stay on at these levels, I do not see stocks moving higher. In fact, I probably see some sort of a decline in stocks over the next 6 months. And in fact, if these tariffs are put in place for 3-4 months, I think a recession is pretty much a fait accompli, as we could say, or pretty much of a sure thing. Again, should you sell for the last 5, 10%, or even 15? Listen, you and I both know, probably, maybe you've done it yourself. I've done it where I've gotten out before the bottom of the market, and then I never got back in as the market went up to new highs. And that's the big question. People always say, well, Dr. Siegel, if you think there's going to be a fall and that's sure I get out now, yes, but when are you going to get in? And by the way, if I tell you to get in, and that's when the news is going to be absolutely the worst, you're going to be very reluctant to get back in. And you're just going to be saying, I'm so happy I got out. It happens so many times. This is so important. The question is not just to get out before the bottom, it's when do you get back in? And that's the hardest thing. And so I have a lot of my friends that tell me they get out of every one, and then I look at their portfolio and their returns, and it's worse than if they stayed in through the ride all the time. So again, I think that stocks are certainly pretty attractive here on a long run, dependent on the tariffs here on the short run. I mean, bonds are a good short-term diversifier. I know last week they weren't so much of a diversifier with some, problems in the market. I don't think those problems are going to repeat themselves because there is some flexibility here on Trump and others on how high tariffs are going to go. This is the high water mark on tariffs in my belief. So I don't think we're going to have any of those. They are short-term diversifiers, but you get no inflation protection. And for those of you out there that are not, can look ahead 10, 20, 30 years, and by the way, many of you who retire at 60, 65 can look forward to 20 and 30 years and more if you're in good health. Stocks are absolutely the place to be and have always been the place to be. And in fact, the return of stocks from bear markets and recessions is greater than the long-run return. And the long-run return is 6.5 to 7% per year after inflation. Cannot be touched by bonds and really not any other asset class. So, if you have that longer horizon, of course, short-run volatility is upsetting, and particularly if you're older in retirement and taking out of it a certain amount, when it goes down, it does certainly affect your outlook going forward. I wish I could say we've seen the bottom. I cannot say that. We could have. If Trump uses an off ramp and decides that that he can declare victory on this, we are going to get a good rally from stocks at these positions. But I do think the important thing for you to know is the fact that the more value and oriented stocks, so stocks with lower price earnings ratios, those stocks that have higher dividend yields, I think are going to be the relative winners through any of these scenarios. Because I think the great 10-year reign of these growth stocks, Mag 7, and they are remarkable companies. But as all things happen, these remarkable companies often move up faster than their fundamentals, and they get caught in a downturn. I'm not saying get rid of everything, get rid of your NVIDIA, get rid of your Amazon, get rid of your Meta, get rid of et cetera, and so on. Many of them now are selling for what they say is reasonable time earnings, but what are their earnings going to be if these tariffs go on? We just saw this morning, NVIDIA taking a $5.5 billion charge, and it can get even greater as we go on. Other companies are beginning to get a charge, and I said I think that they all owe stockholders a real hard analysis of what their dividends are going to be. Now, let's also remember Americans. There's a lot of talk about tariffs, certainly, and potential price rises. Americans have not seen those price rises yet because the tariffs really haven't taken effect yet. There's some talk. There's been some increase in some prices, but the question is when these tariffs bite, what is going to be the public reaction? And no one is going to like to go to the store and buy something from China, which they used to buy at $10, now it's 15 or 20, and they're going to remember that. Public reaction has already been negative, not overwhelmingly, but negative to the tariffs. And Trump does follow those public reaction polls. That's important. And so, the question is, we may have to wait until those tariffs cause those higher prices before we finally get a political turnaround and a declaration of victory. Again, it will be a declaration of victory. Trump will certainly do that. Well, listen, it's a tendency for all of us to do that. If you get a lemon, make lemonade out of it, and try to do the best foot forward. And if we can make some agreements, that is basically going to be good going forward. Let me talk a little bit the tax plan. The House has passed the basic plan. They haven't talked about what they're going to put in it. I think it's very unfortunate that the Republicans, I never believed that my Republican Party would be talking about raising tax rates, back to the Obama levels for higher income individuals. But they're doing that. Republicans never were for tariffs either. So there's a lot of things that are not Republican about the type of economic policy that Trump is following. Nonetheless, despite potentially raising rates, there's going to be a bump up in the deficit. Now, let me tell you, I am not a deficit hawk. I think the world still needs dollars, still the reserve currency of the world, 60 to 65%. The world's reserves are in dollars, about 30% are in euros, about 5 to 10 are in pound sterling. And then scattered there. Yeah, you have a little bit of people saying, I want to get out of that. That is probably why the dollar has fallen, but it rose during Trump's first term. So, during the first few weeks of Trump's second term. And so really what we did is erase that and a little bit more, but we're not at any crisis level with the dollar. And people who invested in the dollar over the long run and in our bonds have done extremely well. I see no chance of any default with any of our bonds. Zero chance of default with any of our bonds. Let me go to crypto and gold a little bit. Gold is on a nice run. It didn't move very much with the inflation that we did have in 2020, 21, and early 2022 until the Fed clamped down. Now it's sort of moving in a delayed fashion. Bitcoin, as we all know, was above 100,000. Now is in the mid-80s. Certainly, the little bit of chaos with the dollar and the Trump's position, I think, enhances both of those. Bitcoin, the difference is Bitcoin has shown not to be a good diversifier. It is correlated very highly with the NASDAQ, which is correlated with risk assets. Gold is a much better diversifier. Now, its price is not low now, and I'm not guaranteeing that that's going to be the best thing in your portfolio. Let me mention that over the extremely long run, which I have done in my stocks for the long run, the return on gold for instance, since my series begins in 1802, so we have more than 220 years, is 1% above inflation. Stocks are 6 to 7% above inflation. Bonds long term are 3 to 3.5. Right now, though, you can only guarantee 2. Treasury bills, etc., have historically been 2 to 2.5, and now they're about 1 to 1.5. So there's your long-term returns, which favor stocks very definitely in that long run. I'm sticking with the market. I made very little changes in the portfolio, moved a little bit more towards dividends, a little bit more out of the growth area, because I think that narrative has basically ended. And I'm sticking with stocks without any question at this particular junction. So those are, I couldn't cover all the topics I wanted to cover. Some of the topics with you. I know that Michael said that there were some pre-submitted topics, and I'm most happy to answer those for you, Michael.
Sure. Thank you, Dr. Siegel, and thank you for providing those remarks. So just kind of the first question, this is actually something that I'm, personally interested in as well. As someone who has such a depth of knowledge on the markets and the history and the long-term returns, how do you suggest investors kind of bifurcate the near-term headlines? The media, obviously, they are going to inundate everyone with near-term fear and everything like that. How do you kind of bifurcate that and say, hey, that is a short-term, near-term volatility metric, but then kind of focus on the long-term, which is undeniable when it comes to stock market returns, their ability to outpace inflation, that sort of thing?
Well, let me say something very self-interested here. I say buy my book, Stocks for the Long Run. Well, look at table chart 1.1, which shows you the long-term returns. And all those volatility points, the great bear markets. And don't forget, we haven't hit a bear market yet. Are little tiny little wiggles in the long-term upward movement of the market, which is so steady and persistent. That's what you got to do. And that's what I do. And, book is, that's what's kept my faith. It was my research in the late 80s. When I saw that, I said, oh, my God, all these big, bear markets, they're nothing in the long run. They're the best way for you to accumulate wealth. And that faith, for more than 30 years now, has held me and has held others and has had a lot of people actually say thank you, Dr. Siegel, because I began. You're right. You're so right. They try to inundate you with fear. Everything is a crisis. Everything is this. It's like you look at in the evening news. It's like, everything is always in crisis, and the market is always in crisis.
Yeah.
And then things that and all the rest. And they talk because they get eyes, they get people watching when you call it that way. So you got to focus on that long run. You got to and that is that long term chart. I don't have it for you because it's so hard to get an actual presentation with things changing day by day without looking dated. I'd almost like to speak to you just person to person. But that long run view has given me and many others the faith to hold on, and everybody who's done so, has thanked me for it. And not only me, but you and your advisors that also know this and have kept their clients in the market because they can take the long-term view. And that's
and
important.
actually something similar to the chart that obviously you're famous for providing, and I always found this one to be an interesting one. And it plots the historic stock market return and then points out and there's multiple versions of this, every bad thing that's happened from Ebola scares to 9/11 and all that, and just basically points every bad thing that you see a headline on and the long-term trajectory of the markets. And then again, it's undeniable for what
it
you
just
said.
disappears in the long. It's a squiggle.
Yeah,
It's a little squiggle in the long term. And yet, when you're in it, you think, "Oh my God, it's the biggest disaster." And listen, we've had 50% bear market.
Yeah.
And so, but on a long-term, what's called a logarithmic, or what's called a long-term ratio graph, these huge declines really don't appear that big. All you see is really the upward thrust of values that beat bonds, that beat bills, that beats gold, that beats the dollar, beats everything else. And that's what's so critical to focus on in the long
Yeah.
run.
Yeah, I agree. Something I was interested in as well, and I know that you've kind of obviously you're famous for making the call in the dot-com bubbles, calling the tech companies a sucker's bet. But and kind of contrast that with some of these, more recent growth companies, you have kind of been, I guess, more supportive of them, even
Yes.
though we as well have kind of identified their valuations got stretched. But what fundamentally is different about some of the growth companies today versus then, and why have you kind of shifted your view there?
Yeah, Michael, good question. Okay. Um, Let me recall that probably my most famous op-ed piece was March 14th of 2000. That was a couple days after the absolute peak of NASDAQ during the mania of the internet. Um, and I often get a question, Dr. Siegel, you called the top. How did you do that? I said, that's just dumb luck, and in fact, the story was the Wall Street Journal called me 2 weeks before that and said, Dr. Siegel, have you been watching what's been happening in the market? I said, well, that's what I do for a living. So I think the answer is yes. Um, do you want to write do you think it's crazy? I think it's crazy. Do you want to write an article for us on it? Okay, I'll write an article. And I really spent a lot of time on it. And what is different? Okay, let's put it different. The the Mag 7 of that era, JDS Uniphase, EMC, AOL, Sun Microsystems, I can't recall them off my head, but those were the ones that Oracle and Nortel Systems, and those were the ones. They were selling for 200 times earnings. And let's face it, the Mag 7 really on a forward basis, on a backward basis, they probably got to 40. On a forward basis, they were probably more at 30, 35. So they never got to the craziness levels that we saw on the internet bubble. And so as a result, I'm saying they're just not as crazy.
Hmm.
I'm not saying they were not overvalued. Yes, their value was huge. I mean, the Mag 7 was what 35% of the S&P at one point. And that was higher than the so-called Mag 7, if you want to say, of the 2000 era were. They weren't as big as these, but they weren't as, I mean, they were, many of them, a couple of them had been existing, but none of them had the global reach of, Meta, Amazon, Alphabet, and the Mag 7 of today. Nor do they have the earnings. I mean, some of them had earnings. Cisco had earnings. Selling for what 100, 200 times earnings. I mean, some of them had earnings. Some of them didn't. All the Mag 7 had earnings and had tremendous growth. So I said there was a qualitative difference between the two. In
Hmm.
fact, I made the point when I was first interviewed about this actually in February last year. Fortune magazine put a big article about it, and I said, and they said, well, if things got as crazy as they did in 2000, what would these stocks be at? And I said, well, Nvidia and these others would be 4 times as high as they are today. 4 times as high. And it never got there. I mean, it kept on going up a bit, during the next year, but 20%, 30%. I said, that's how crazy things were in 2000.
Yeah.
And so that's why now, again, saying things are not crazy doesn't mean go out and buy them. I'm just saying, and I'm telling you how far mania can go. Mania could go really far in each direction. One thing you got to use in the market is that mania can bring things 2 to 3, 4 times as high as they should be, and depression and despondency can bring things down, 50, 60, 70% lower than they should be. And
Yep.
and neither of those times should you buy when it's high and sell when it's low because of the prevailing sentiment. Gotta you gotta protect yourself from that prevailing sentiment. Right now, and I see stocks, you know, I mean, the Mag 7 stock selling at 18, 19, and lower times earning some 15. You One thing I've learned, Michael, and that is not learned, but it's analytically and empirically true. When you have a low PE stock, you don't need much growth at all. You don't need it to grow. You just need it to survive and keep on pumping out what it's pumping out. When you have PE stocks in the 30s, they have to grow and meet expectations all the time. Give me a 12 PE stock that doesn't grow at all over the S&P 500. I mean, if you get a stock that just survives at a very low PE, it doesn't have to grow to give you a good 6, 7, 8% return after inflation.
Absolutely.
That's important. Also, what's really important, and I'm just restating what I said before, we would not be getting the great long-term returns in stocks if they didn't have short-term volatility, right? If they were steady every year, giving you 6, 7% after inflation, everyone would just rush to them, and that's all they would buy. It's
Yep.
these scary moments that you have to live through that
Yep.
give them the discount in the price that allow you to get the return that you get.
I always like the old adage, you should be fearful when others are greedy and greedy when others are fearful,
Yeah,
correct?
absolutely. And you
Yeah.
should also recognize that you would not get the premium on stocks if you did not have its volatility. That's hard for people to understand, but it's because if stocks grew the same amount every year at the rate that they have, I mean, they would be bid up to the sky, because the fact that they're not is because you got to live through these periods. I mean, and so if you can, insulate your emotions from these periods so that you hold on and you don't make the common mistake of selling at the bottom, you're going to be the winner. You're going to be the
Absolutely.
winner on the stock market.
Okay, so just bringing us a little closer to today, and obviously with all the trade talk, obviously there is the public motivation for kind of narrowing the trade deficit. But how much do you think the kind of the tariffs that are projected to be placed on China is also kind of tied into the AI tech race, trying to
Yeah.
help the U.S. on that front?
Yeah, and China did steal a lot of our stuff and should be penalized on that. Very definitely. I think we're taking precautions now we didn't then.
Hmm.
So that's one phase. I think that should have been done on an international basis, and I think they would have gotten a lot of support because a lot of other countries are upset. We should have put really strict restrictions on that. But now we got blanket ones. I mean, that are 145%. None of them are even non-technology. Making waste paper baskets is now 145%. I mean, I don't know what they're stealing technology there. There does not seem to be the discrimination. Yes, we've got to really come down hard on this. And yes, to some extent, we need to produce more here. Although, let me tell you that it would be far better economically if we stockpiled things that we needed. It's a much lower cost than stockpiling a lot of what we needed if we had a temporary crisis. I mean, we do have what's called the petroleum stockpile, but we could stockpile masks and the things that we needed during the pandemic. We could stockpile a lot of things to get us through at the beginning. Sure, we should have some production capability, but we also need to realize that global trade has to enrich the world, both sides. And one also has to realize, I mean, and this is what I have, I mean, it just totally puzzled me when President Trump says this. They've stolen from us, they've gained us and hollowed us out, when the GDP in the United States has grown faster than the GDP in Europe and some of the other developed countries. Now, not quite as fast as China, but China started out with zero. And by the way, now with its economy only at 1/4 the level of the United States, it's slowing down to 3, 4%, if you can even believe those figures. So it's way behind. no one is, no one has outperformed the U.S. The U.S. had exceptionalism. We outperformed everyone. So I don't understand, this idea that they've all stolen from us and, run away with it. They have absolutely not done that. Again, I don't like, the China measures against technology and all that. You can ban the advanced chips and all that. Although I have to tell you that they're pretty far along on a lot of stuff and they've got a lot of intelligence there. I don't know how much the embargoes now would do a distance. They probably would have done more years ago. I
Hmm.
mean, you're dealing with a pretty technologically advanced country on some of these fronts. That has actually surprised people. I mean, DeepSeek has surprised people. BYD as an electric car company, even Elon Musk said, I'm surprised at what they can do at the cost that they can do it. And we keep on getting surprised at what it is. So, you know, are we in essence closing the doors of the barn after the horses
They left the
have
stable.
left?
Yeah.
And listen, I mean, I still think we can compete with them. I still think the best genius is here, and I think we can outrace them, even if that they've caught up. But they're pretty high in this AI race. I think they're probably second highest country on the AI, and yet they're still, interestingly enough, a developing country. 1/4 the per capita GDP. I mean, they don't rate in any. Many countries, Greece, Portugal, you keep on going, are twice as rich as they are on a per person case. But having the biggest population in the world, well, second biggest to India, having, they have 4 times the population in the United States. They have 1/4 the per capita income of the United States, and that's why their size as an economy is the same. So every person is as quarter rich, and they have 4 times as many people. So this is second grade math, and that's why there is that's where they are right now. But they're a big economy, and listen, could they get to half the per capita income of the United States? Absolutely. And take a look at South Korea. South Korea is 60 to 70% of what we have in the United States. And it started out poor in 1950, 52. South Korea was poorer than China, and now it's 2 to 3 times is the per capita income. So these countries can definitely grow, but under a communist one-party system, that's a big strike against it.
So,
A big
so
strike.
just
There's a lot of big strikes against China.
So just to piggyback on that, and we've talked about this with our clients, and the old saying is demographics is destiny, and some of these countries are showing their populations are not growing, and the United States tends to kind of outpace in that front. How do you think that will play out long term
Yeah.
for all these economies? And
Well,
obviously there's
the
all
aging is
these
a
global
definite
race.
problem. Yes, Michael, the aging is definitely a problem for China.
Hmm.
It's definitely a problem for Japan. Aging is definitely a problem for Europe, particularly Southern Europe, which even has the lowest. The United States still attracts the best talent. We have the best
Hmm.
educational system in the world at the highest level. And we attract that talent. We attract young talent. It's a free young talent is what you need, that feel free from strictures, that can do the research that they want to do, and then do well by it, if they so choose, to make that product here or sell their product there and do that. And we still have the best climate for innovation. We in the United States have the best climate for innovation in the world today, bar none.
Okay. So you mentioned a little bit there, but the potential for tax cuts, and I
Yeah,
think as we've been telling our clients about, if nothing is done by the end of this year, we revert back to the Obama era tax
right.
code. The 2017 tax cuts are set to expire. Um,
Yes.
Do you think there could be kind of a tale of two halves of the year, where the first half of the year, obviously President Trump has been very focused on the tariff front, but he also knows by the end of the year he has to get through a tax cut. Do you
Yeah.
think he will focus that? Do you think the markets will
Oh
celebrate
yeah, he
those if they
wants it
come
way
through?
before then. I mean,
Hmm.
he's almost put a June deadline on it. Now, you see, my recommendation right at the beginning was he should first do the tax cuts and wait later for the tariffs. I think the tariff thing might complicate this whole tax cut situation, whatever. But it is what it is. Okay, so what do we have now? One has to remember now these tax cuts, and I think the tax cuts in the first administration were much more important and excellent. I mean, reducing the corporate tax rate, from 38% to 21,
Hmm.
reducing capital gains tax, and increasing the exemption for the estate tax. I could go on and on and on. A lot of excellent things. Broadening the brackets, lowering the number of people, including increasing the standard deduction, lowering the number of people that are filing. I can go on and on. The truth of the matter is, although there are some very good features to Trump's second, it's not as big and important as the first. Let's face it. Um, he's talking about only reducing the corporate tax rate to 15% and for domestically produced only. I mean, that is good. I think that's an excellent proposal. But compare that from going from 38% to 21 for everything. It's just
Hmm.
is smaller. He's not
It's
talking
much
about
larger.
he's not talking about cutting the capital gains tax anymore. He said very little about anything that depreciation or other things that are going to directly help cap, except lowering regulation, which he did a lot in the first term. Biden brought some of it back. He's taken some of that off. That's very positive for the U.S. economy. Not as positive by any means as tariffs are negative, but it is a positive for the economy. The other tax cuts, Social Security, I don't know if there's going to be an income limit there. He talks about raising the SALT deduction, okay, from 10 to 25,000. Hey, that's that will a little bit make up for his tax on the higher brackets if he does go that direction, which is uncertain. Say, lowering the tax on tips, that has to be very narrowly defined. Let's face it, all these are small compared to what he did in the first term.
Hmm.
And I'll argue with anyone and I think one of the mistakes of a lot of people was, oh my God, another set of tax cuts. And they thought the same record would, we're playing the same record when he was elected in November of 2020, four as we were playing in, November of 2018. 2016, 8 years ago, 8 years before that. Oh, no, that was not the same. It's not the same record because he
Hmm.
did most of those things and helped the economy. Now there are other things, and some of them good, some of them not so good, but they're not as I'll be frank with you, they're nowhere near what it was the first, and in my opinion, nowhere near the harm that would be done if the tariffs continued.
Hmm. So now we talked a little bit about the deficit and debt to GDP ratio. Obviously, you don't sound, you're not really as alarmist to that
No,
front.
no.
But do you think the efforts on the Department of Government Efficiency, tariffs, all those tax laws, do you think that will have an impact on the overall
I
debt, or do
love
you think
I
it's
like
kind of?
Doge. Absolutely, we need to shake things up. That was fine. You could argue about the way he did, et cetera, and so on. We need that efficiency.
Hmm.
How much tariffs they'll bring in, I don't know. I mean, at current levels, nothing will be brought in from China because there'll be no trade. I
Yeah.
mean, they both admit it's like an embargo. So, I mean, you can't start multiplying 145% on last year's trade with China. So, I mean, the truth of the matter is, listen, if you want, I could get into a big academic discussion about, I would like to get out of the income tax completely, not tax capital, and go to a value added type of tax. And which, by the way, a small level of tariffs is okay with that. But he's not doing that, not yet.
Mm.
I mean, that's
Okay.
if you really want to talk about the ideal type of tax system, it's a value-added tax, basically, and let's do away with the income tax. By the way, we're the only major country in the world that doesn't have a value-added tax. We're also the only major country in the world that relies on an income tax to anywhere near the extent of any other country. And we're the only other country. I think we're the only other country that spends something like 20. And now it's the day after tax day. So what we spend $20 billion on doing our taxes. No other country. They laugh at us when they say that. They spend about $10 to $20 million on personal taxes. That's about it. Less than 1/10 of 1%. So I mean that's a waste. We could go on that. What you could talk about what I think is the ideal tax plan was moving towards that. But at this particular juncture, yes, he's taking some people down on this tax. Others are up. And this a lot has to do with what the Senate's going to do with pass-throughs on deducting state and local and what kind of tax rate you can get. I mean, that's definitely going to get one of the. That's definitely going to be one of the things. I mean, and that yet to be argued, and he will get it done. There's no question
Yeah.
because you are absolutely right. December 31st, ding. That's a deadline. If nothing happens, you go back to Obama rates. That's what disturbs me about this talk by Republicans about getting the tax rate back to 39%, sunset for that is the Obama rate on the high levels. Not good. But nonetheless, I mean, so we're going to have a tax cut, no question. He's going to pass it. It's not going to have anywhere near the effect that the first one had. Getting trade deals done, and getting those tariffs off is a much more important, in my opinion, issue for Trump to move on in the next 8 months of this year.
All right. Well, in closing, I guess, obviously we wanted to thank you so much for joining us, Dr. Siegel, but just to give you a little softball as the last question, do you still think stocks will be the best asset class in the next 3 to 5 years for investors? This is a softball, of course.
I 3 to 5 years, absolutely. I don't think we're going to have the tariffs anywhere near this level in 3 to 5 years. And bonds at 4% don't do it for me. And T-bills at 4%, which could go down to 2%, don't do it for me. No, I'm absolutely with stocks.
All right. Well, great. Well, Dr. Siegel, thank you so much for joining us. Just speaking personally, I found all your insights to be enlightening, and I'm sure our clients and prospects did as well. Just as a reminder to everyone, this meeting will be recorded, so be on the lookout for the replay of the webcast today. And if you do have any questions, please reach out to us at pwm@prestigewmg.com. And with that, I want to thank Dr. Siegel again, and then we hope to see you again soon.
Absolutely, Michael. Enjoyed being with you, and take care.
Thank you so much.